So, you've had your divorce, you're swimming in debt, you owe your lawyers $40,000, $50,000, you've lost 60 to 70% of your asset base, you've maxed out your credit cards, you're nearly bankrupt, and you're struggling to find a way out, and things are looking pretty grim. Stick with me, because I'm going to go through a few simple tips to help you raise the Titanic, help you rearm the Missouri, and start firing with all guns blazing once again. Hey, welcome back. Well, the first thing to say is I'm not a financial advisor, so I'm just sharing with you some of the things I researched and found helpful to myself. So please do make sure you talk to your own financial advisor, corroborate what I find, or find a more effective way. But what I want to talk about is how I managed to research and get myself out of trouble and share that with you. When I was going through my divorce, as I said in the intro, I was very near bankruptcy. My credit cards were maxed out. I'd taken out a loan to pay my lawyers. I'd lost 65% of my asset base. I'd really struggled to get my living quarters arranged. And it was a really, really difficult period. I was in a depressed state, so work was not as good as it could be. And I was really struggling, psychologically as well as financially. So I began reading, and a couple of influential books that I wanted to mention was The Barefoot Investor, and I'll talk about that in another video. But the book I want to talk about today, and the seminar I went to that really made a massive difference, which I'm going to summarize roughly, is The Money Mentor by Graeme Holm, and I'll put the description down below. So there are basically a couple of things that you need to consider here. First is, if like me, you had to refinance your home loan to pay off your ex-spouse, then that necessarily involved taking on more debt to max out your credit right to the hilt. And the first thing you need to do when you do this is make sure you take out as much as you can to pay off all of the other debts that you've got. The high interest paying credit cards, firstly, shred them. If they're maxed out, that means firstly, you can't max them out anymore. Secondly, it means you can't be trusted with debt. Not right now anyway. So shred them, and that'll stop you from dipping into them unnecessarily. On the subject of credit cards, what you ought to do first, while you're in the process of refinancing your mortgage, is look for some of those zero interest credit cards that go from 10 to 12 months, and they do balance transfers. So transfer into those accounts whatever you've maxed out, because that'll give you some breathing space for at least 6 to 12 months with zero interest until you get your refinance sorted. That refinance should pay off those credit cards, and then you never want to see them again. So that's your first tip. When it comes to refinancing your mortgage, the most important thing that you need to do is to make sure you need to have a fully transactional mortgage account. On the subject of mortgages, the word mortgage basically implies a lifelong debt. That's how it's meant to be structured. 25 to 30 years of slavery. The bank does not want you to pay off your mortgage in less than 25 to 30 years. The reason for that is that the vast majority of loans, and especially mortgages, are what are called front-end loaded, which means that, let's say you're paying off a mortgage of, say, $3,000 a month. More or less $2,000 of those $3,000 will be interest. And for the first 10 to 15 years, that's the way it's going to remain. 2/3 roughly of your mortgage repayment for those 10 to 15 years are going to be interest. The principal will be very small. In fact, you'll be paying $8,000 to $10,000 off your interest per year as opposed to $20,000 roughly for interest. And it's only halfway through the loan that you'll be balancing that out, 50-50. So 15 years into a mortgage, most people have barely paid off $50,000 to $100,000 with at least $400,000 to go. So it's only in the second half of that mortgage that they start paying it down. So what you need to do is smash as much money as you possibly can into that mortgage in the first 5 to 10 years. If you can chop down the bulk of that interest early, you're going to save yourself an awful lot of money. Now, most people are paying approximately $55 to $60 a day in interest in their repayments on a mortgage. If you could shave off $10 a day off that amount, it will significantly decrease the overall repayments that you make over the life of that loan. So I'm going to show you some graphs that illustrate that. The idea that Graeme Holm tries to convey to all of his students is, first, get a fully transactional home loan. Second, you only need one other account. And that should be a fully offset transactional account tied to that mortgage with a 100% offset. Make sure that you confirm that it's fully transactional and it has a 100% offset on the home loan. Graeme says there's a trend going on within the banking industry right now to create a false sense of saving amongst people. So they offer you multiple transaction accounts, don't charge you any transaction fees, to help you budget and put money into different accounts. For example, you might have an account for savings, you might have an account for education, you might have an account for holidays, an account for debt reduction on your credit cards, and so on and so on. Many banks now offer up to 10, 12, even 15 sub-accounts to help you budget and bring down all of these expenses. Now, none of these accounts are paying you more than 1 or 2% interest at most, which is crap, right? And the interest you make on that is taxable, which means every dollar you make in interest, you're paying 30, 40 or more percent interest, depending on what your margin is. Graeme says the best thing to do is pour all of your income, pour every dollar you have straight into your mortgage. And then from that mortgage, what you're going to do is pay all of your bills and expenses. So that's why it's important to have fully direct debit capabilities, in other words, fully transactional capabilities on your mortgage account so that you can pay all your bills straight out of the mortgage. And the point of that is that if that money is sitting in your mortgage, it's reducing the interest that is calculated daily. So your interest on your home loan is calculated daily and charged monthly. So for every dollar less that is on that principal, for every dollar less that you owe to the bank, they charge less interest. Over the course of 25 years, that's a significant saving, and it'll shave down the front end of that loan substantially. I'm going to show you some slides on that will help you understand it. In the full offset transaction account, you're going to deposit a set amount every week, which is your budgeted amount for discretionary expenses. Now, what I mean by discretionary expenses, petrol, entertainment, lunches, going to the movies, all of those sorts of little expenses like coffees and so on that you'd spend cash out of your pocket or just use your card for every day. You need to run yourself a little budget. For most people, it turns out to be about $750 a week that they need for these discretionary expenses. So from the mortgage, you're going to transfer $750 into the offset transactional account every week, and you're going to live off that. And when you run out of those $750, you're going to have to chew your nails, eat the soles of your boots, or just wait until your next week's $750 deposit. That's as tough as it gets. Now, if you can't survive on $750 a week, you really have some introspection to do. Otherwise, you're going to have to pull your head in and find other ways of making money. But if you earn a couple of $1,000s a week, you need to pour every single dollar of that into your home loan. And then from that, put $750 into a transactional account as a discretionary spend. Everything else remains in the home loan. All of the bills that are direct debit come straight out of the home loan so that they sit there as long as they possibly can until those bills need to be paid. Every day that you have $1 extra in your mortgage is an extra less amount of interest that you need to pay to the bank, which means it's faster payoff time for that front end load. You got me? Good. The next thing you need to do is really start assessing your spending. And by that I mean, what are you wasting money on? Coffees? Lunches, when you could be taking a packed lunch to work? Clothes? Do you really need those high-end clothes? Can you live without it until you get your debts down? You need to really do some soul searching and ask yourself what's really, really important to you right now. If you keep swimming in debt, if you've funneled your money off into 5 different accounts and you start using those and juggling between them and then pulling out of one account to stick into another one and then pay a little bit of a credit card and only doing minimum payments, you're never going to get out of the hole that you've dug yourself in. So what you need to do is really start getting a spreadsheet going and look at every single dollar you spend and where it goes and does it need to be spent there. It's going to be hard for a little bit, but once you know the numbers, you can dig yourself out. What you can count, you can control. And I want you to really think about that. What you can count, you can control. One of the ways you can control discretionary spending is by not going to the shops every time you need something. Write down a list on your fridge or on your kitchen table, and once a week, go online shopping. There are a lot of apps available now for all your grocery stores. You can save your favorite items, which even saves time for you, and you shop once a week online, have them delivered home. That way, you're not strolling through the aisles and thinking, oh, I think I like that packet of chips. Oh, I'd like to try that new cake. Firstly, you're going to lose weight. You're not going to be a fat pig, which means women are going to dig you more. So that's going to be important once you get out of all the depression and self-hatred and shame and guilt from divorcing someone who was really not ideal for you anyway. But the second thing and more important thing is you're going to start saving money once more. And every dollar counts, as I've said. So online shopping, have it delivered home, limit your wayward discretionary spending. And the final thing I'm going to say on this subject today is you need to renegotiate your home loan, especially if you've had it for a while, to get the interest rate down. Now, this can have another huge impact on your home loan. You may or may not be able to do this, especially if you've only just got a new home loan. But if you've had one for a while, so the next thing you're going to do is you're going to call your bank and you're going to say to the nice person on the other side, would you please mind emailing me the discharge forms for my loan? Now, that's going to set in motion this whole panic in the hierarchy of that bank, because that means you're getting ready to pay out your mortgage or renegotiate with another bank. What banks do in situations like this is they immediately initiate renegotiation. They don't want to lose a customer that might be a slave for the next 30 years. So somebody will call you and discuss what's wrong, why are you leaving, why would you like to pay out, is there anything else we can do? And this is when you're going to say to them, well, I've been offered a better offer and a lower interest rate, so unless you can beat their offer, I'm going to go elsewhere. In which case, that will again set off a whole lot of negotiations. And if you know your material, you're going to be able to negotiate 0.5%, 0.25%, 0.75%, perhaps more. Every percent, every 0.25% counts. So it's a really important way to get them to lower your interest repayments. If you just rang your bank and said, I'd like to lower my interest, they're probably going to palm you off, fob you off, ignore you, tell you they'll call you back later, and so on. But if you ask for the discharge papers, that's a whole different ballgame. And Graeme says it's one of the best ways to get them to take action to save you as a customer. I did it and it absolutely worked. So I guarantee if you give them a ring and negotiate on that way, every little bit helps and you may save yourself tens of thousands of dollars in the long run. Well, there you have it. A couple of ideas, hopefully that'll help you dig yourself out of the hole that you're in, get your debt levels down, and renegotiate a better deal with banks and the home loans. So do have a read of Graeme Holm's book, The Money Mentor. I'll put the link in the description below. If you've got any questions, email me. But within 5 years, following this course of action made a substantial difference in my debt levels to the point where I'm now ahead and I'm ready to start investing. So if you do at least what I suggested in this video, I seriously believe it's going to make a difference to where you're headed in the short to medium term. So again, email me if you've got any questions. Please do talk to your own financial advisor, fire some of these suggestions of mine at them and see what they tell you. And please don't ever make any decisions without good advice. Until next time, walk tall. Cheers.